Contractors, Kristin here, CPA and Certified Construction Industry Financial Professional at Katz-Abash, a CPA and consulting firm specializing in construction contractors. Here with us today, we have special guest speaker, Claudia. She's going to go over the major changes upcoming to the financial statements. Claudia is a leading shareholder in our accounting and auditing division, and she's also a certified construction industry financial professional as well. So to give you a little bit of background on the upcoming change, if you're working with a CPA to prepare financial statements for a bonding company or a banker, you're most likely using the framework generally accepted accounting principles to prepare those financial statements. And there's going to be a major change relating to leases for years ended 2022. Under the current rules, there's two types of leases: a capital lease that you put on your balance sheet as an asset and a liability, and an operating lease where you just expense the payments as incurred. Going forward, there will be two types of leases: a financing lease and an operating lease, but both of these types of leases will require the contractor to record an asset and a liability on the balance sheet. So you can see this is going to be a pretty big change. So Claudia, what is something that contractors can start to do now to prepare for this change?
Well, recently we presented a webinar on the leasing standards, specifically to contractors. That webinar is on our website if you want to take a look at that. I'd say just start gathering your leases, because if you have an old lease, it might be hard to find. There might be amendments, so start gathering all that information now and get it in one place so you're more prepared as you try to implement.
Are there any unexpected consequences of such a change as large as this?
Yeah, I think, for tax purposes, we're not going to be using these standards. So we're going to have to reverse all of these gap adjustments for tax purposes. So when you're looking at your income during the year, this is another one of those book to tax differences. And you'll want to talk to your bankers and your bonding companies about these changes as well. We've been trying to talk to them, but it still, I think, is going to come to a surprise to some of them. Debt covenants could be impacted depending on the type of debt covenant. If you have a tangible net worth covenant, it's possible that the bank doesn't know how they're going to classify these leases, so it could impact that. As well as if you have a debt to equity ratio, you're going to be putting a lot of debt on your balance sheet. So you want to make sure that the bankers are prepared for that, because it's going to change those calculations.
What is the largest hurdle our contractors are going to face when implementing this change?
I think one of the things that's really challenging when it comes to operating leases is you're putting an asset on your balance sheet, but you're not amortizing that asset straight line as you would typically amortize like a piece of equipment. So the amortization on that asset is a plug, because the lease expense is straight line, and it's a goofy calculation. And so you're going to either need software or a really powerful Excel spreadsheet that you put this information into. I would say, you'd only want to use Excel if you have a handful of leases. If you have a lot, you're definitely going to get some type of software. If you have like a master lease agreement where you have a lot of leases with a particular company, like for vehicles, you might want to start talking to them now to see if they can provide you with reports to implement these standards, because we've encountered that they do have these. So, just find out about that in advance.
What are some of the other challenges that contractors will face?
So there's a lot of disclosures around this, and there's some things that you're going to have to make some judgment calls around, such as determining, you basically have to take the present value of your future lease stream. So you have to provide some type of, interest rate or incremental borrowing rate. So you're supposed to use your incremental borrowing rate. There are some practical expedients that you can use the risk-free rate for that. But the risk-free rate is based on the term of the lease. So if you have a 5-year lease versus a 20-year lease, you're going to have a different incremental borrowing rate. And there's just a lot of disclosures. You have to calculate the weighted average remaining life and just some other kind of goofy things that they're new to us.
Okay. Any other tidbits of information we want to pass along to our contractors?
There's still some unknowns out there. We're not entirely sure what's going to happen if you have a related party lease that's a short-term lease. You're supposed to look through to the legally enforceable terms of the lease. But if you have a related party lease that's month to month, and you guarantee the mortgage, it's a $3 million mortgage, you're basically still on the hook for $3 million. Or if you've put $500,000 of leasehold improvements into a building, you're likely not going to move out in a month. So those are some of the unknowns we're still trying to figure out. I'd also say, start gathering your leases now, look at the provisions of the lease, getting all those terms together, because, the more prepared you are, the less costly this implementation is going to be for you.
Mhm. Thanks, Claudia. This does sound like a very complicated and large change. So if you are a CATS ELASH client, please be on the lookout for your team member to reach out to you this year to start the conversation around leases. And if not, please feel free to contact us. We'd be happy to help answer any of your questions related to this change. So thanks for watching, and I'll see you next month.
Thanks.